How come no one talks about how insane it is that every currency has a different value? Is it because the printing process is different, or is there something bigger at play? Bob, an everyday guy living in America, uses the US dollar almost daily without a second thought. But when he plans a trip to Germany, he quickly realizes something interesting. 1 US dollar doesn't equal 1 euro. Instead, it's worth only about 90 euro cents. Later, Bob visits Vietnam, where 1 US dollar translates to a staggering 25,000 Vietnamese dong. This raises a fundamental question. Why does money have different values across the world? Why isn't 1 US dollar the same as 1 euro, 1 yen, or 1 peso? And what's the deal with exchange rates changing every single second? In this video, we're diving deep into the fascinating world of currency, exchange rates, and the global factors that shape the value of money. By the end of this journey, you'll understand not only why currencies vary in value, but also the economic forces that dictate these fluctuations. Let's uncover why money isn't as simple as it seems. The fifth reason behind this will make you put on your thinking cap. Let's go through a short history of money. To truly grasp why currencies differ, we must first rewind time and explore the origins of money itself. For centuries, money was directly tied to precious metals like gold and silver, a system known as the gold standard. Under this system, a country's currency was backed by a fixed amount of gold. For example, the US dollar once had a direct link to gold reserves. This setup ensured stability, since governments couldn't simply print more money unless they had gold to back it up. However, as economies expanded and global trade accelerated, the gold standard began to falter. Countries found it increasingly difficult to maintain sufficient gold reserves, especially during times of war or economic crises. By the 1970s, most nations transitioned to a new system called fiat money, unlike gold-backed currency. Fiat money derives its value from trust in the government that issues it and in the economy supporting it. If people believe in a currency, it has value. If they don't, it loses its worth. This is why strong economies like the US have higher currency values, while struggling nations face devaluation. Fiat money's value is driven by supply and demand, meaning it's susceptible to changes in public perception, economic strength, and market forces. This brings us to the factors that influence currency value, starting with inflation. Reason 1. Inflation. Inflation is one of the biggest culprits behind currency devaluation. In simple terms, inflation occurs when there's too much money in circulation relative to the goods and services available. This diminishes the purchasing power of money over time. For example, in 2022, you might buy 2 loaves of bread for $10, but by 2024, inflation could reduce that to just 1 loaf for the same amount. A real-world example is Zimbabwe, which experienced one of the worst cases of hyperinflation in modern history. In the 1980s, the Zimbabwean dollar was stronger than the US dollar. However, poor governance, economic mismanagement, and uncontrolled money printing led to catastrophic inflation. By the 2000s, 1 US dollar was worth hundreds of thousands of Zimbabwean dollars. The government even issued trillion-dollar bills that were practically worthless. Ultimately, Zimbabwe abandoned its own currency in favor of more stable foreign currencies like the US dollar. Reason 2. Interest rates. Interest rates, controlled by central banks, are another critical factor. These rates determine the cost of borrowing money. When a country raises interest rates, it offers better returns for investors, attracting foreign capital. To invest, these foreign investors need to buy the local currency, increasing its demand and strengthening its value. For example, if the U.S. Federal Reserve raises interest rates, investors may sell their euros or yen to buy U.S. dollars for investments like government bonds. Conversely, when interest rates fall, the currency becomes less attractive, leading to reduced demand and a weaker value. However, there's a catch. High interest rates can also slow economic growth by making borrowing more expensive for businesses and individuals. Central banks must carefully balance these rates to maintain economic stability. Reason 3. country situation, and foreign investment. The political and economic stability of a country significantly affects its currency's value. A stable government ensures predictable rules for businesses, encouraging foreign investment. When China opened its market to foreign investors in the 1970s, global companies flocked to the country. They needed Chinese yuan to operate, which drove up demand and strengthened the currency. On the flip side, political unrest, corruption, or economic instability can scare away investors. For example, countries with high debt, frequent protests, or erratic policy changes often see their currencies lose value. Stability attracts investment. Instability repels it. Reason 4. Export and import. A country's trade balance also plays a key role. When a country exports more than it imports, it creates demand for its currency. Take Japan, for instance. Countries buying Japanese cars need to exchange their money for Japanese yen, increasing its value. Conversely, when a country imports more than it exports, it spends more of its currency abroad, reducing its demand and value. An interesting case is the U.S. dollar's dominance as a petrodollar. Most oil-producing countries price their oil in U.S. dollars, forcing nations worldwide to hold reserves of the dollar for oil transactions. This has solidified the dollar's position as a global currency. Reason 5. Fixed value. Some countries simplify their currency management by pegging their currency to a stronger one. For instance, Brunei pegs its dollar to the Singapore dollar at a 1-on-1 ratio. Similarly, Belize fixes its dollar to the U.S. dollar at a rate of 1 minute and 0.5 seconds. While this approach stabilizes a local currency, it ties its fate to the pegged currency. If the U.S. dollar fluctuates, so does the Belize dollar. Why don't all countries use the same currency? The idea of a single global currency sounds appealing, eliminating exchange rates and simplifying trade. However, it's fraught with risks. For example, within the Eurozone, member countries share the euro. While this fosters convenience, it also means individual nations cannot control their monetary policies. When Greece faced a financial crisis in 2009, its struggles impacted the entire Eurozone, including stronger economies like Germany. A global currency would amplify these risks, making one nation's problem a worldwide crisis. Should a currency always be as strong as possible? Not necessarily. A strong currency benefits importing countries by making foreign goods cheaper. However, exporting nations often prefer weaker currencies to make their goods more affordable on the global market. For instance, China has been accused of deliberately devaluing its currency to boost exports, a strategy known as currency manipulation. By understanding these concepts, you will see that currency values reflect a complex interplay of economic, political, and social factors. If you'd like me to dive deeper into any of these topics, let me know in the comments. Thanks for watching, and don't forget to like and subscribe